Welcome back to OETV and the start of your work week. The last week to the third quarter, this is the last week to the third quarter, which has been a volatile period for investors. What will this week hold? We have Brendan McCarty from Column E back with us to look at some of the events that can impact the markets and some share prices this week. Welcome back, Brendan.
Hey, welcome to you. Good to see you again.
Now, this show is brought to you by the wonderful team at Open Exchange. Look to them for all of your virtual event needs. Okay. Is it too late to sell? Markets have fallen 5 of the last 6 weeks. The Fed is maintaining its hawkish stance. Inflation remains high, and that word recession is still front and center in everyone's mind. So, Brendan, it begs the question, is it too late to sell, or is there further downside to this market?
So this is my financial planning hat on now. I haven't done this in a long time. I'm just kidding. From a trading perspective, I think we go lower. Money turned lower last week. The more I think of it, the more the June low was sort of an aberration because money jumped at the June low and the markets just randomly jumped. I think we're moving lower. I mean, you couldn't tell by this morning. They seem to be buying every dip. Like these computer programs and these algos, they don't care. They just keep buying. But I think we're heading lower. 3,500 looks like the next target. Watching 11,500 NASDAQ 100 though. If they can hold that level, that argues the economy may be stabilizing a little bit. Both have lousy breadth, doesn't support a jump, and then monthly momentum is moving lower. So the way I would play it, if you were stuck or trapped, the short term looks like we're getting a little bit oversold, but ultimately we get down to that 3,500. If it goes up to 3,800, maybe you sell into it. But if money continues, the bottom line is money is coming out of the system. That is not asset friendly. If the Fed were to stop that and stop raising rates, that changes dynamics. But they're still in a tightening mode, and that's not good for assets nor equities. We were playing all summer the bounces, but this market looks like it's running out of bounces.
Okay, but Brendan, we also have a lot of economic data out this week. Durable orders, consumer confidence, new home sales, GDP, and PCE prices. We're in an environment where any disappointing news can trigger aggressive sell-offs. Brendan, do you think that any of these data releases could disappoint and trigger that sell-off?
So we thought CPI would do that. We thought that upside, like if CPI were to be weaker, you'd have a mild rally. If CPI was strong, you'd see a sell-off. We didn't see a 200-point sell-off in the S&P, of course. I don't think anybody did. That's why it fell so much. But that is the risk that we were running into. I think, though, now markets priced all that in. And I think the story is tighter Fed, knee job weakness to support the case that gets the Fed off our back, so to speak. I think there's 3 things to watch this week in terms of economics. First is the conference board in terms of confidence. That is a really good indicator of job growth. If the confidence is down, typically speaking, job growth is actually slowing as well. So that's something to watch. Second is the claims data. That's on Thursday. That's the strength. That will show, I mean, that has held in remarkably well in this downturn. I think we're still like claims of like 220, give or take. If the Fed if you want to see 5% unemployment or even 4.5% unemployment, those claims data need to climb. So the market needs to see that. They need to see job losses rising to get a little bit, more excited. Finally, University of Michigan is the bi-monthly event or bi-weekly event. Comes out twice a month. I get that always wrong. But anyway, University of Michigan, it's the inflation expectations area. Everybody watches this small sample, but it's been on target. Basically, if investors, this could be like the CPI report going the other way. If they come in and say, all right, investors see, the people in the survey see inflation actually coming down more aggressively, that could get investors buying. If the Michigan survey people see inflation rising, that might just already be priced in the market, so the sell-off won't be so great. So that's the way I would look. Those are the 3 ones to watch this week. I think those are important. I think we've gotten a lot of negativity, and the upside surprise is now greater to the downside surprise.
Okay, well, let's move on to last week where we saw a quick spike in share prices for Robinhood and Virtu after news broke that the SEC is not going to ban the practice of payment for order flow for retail orders. Over the years, I've spoken to traders on both sides of the fence on this one. Some saying that it gives them better access to liquidity, while others say doesn't give them the best price. It's a very profitable practice, though, for those in the space, especially TD Ameritrade, as you see in this slide, for their June volumes. Brendan, you and I have been around a long time in these markets. How do you feel about the payment for order flow business?
So I understand why it exists. I understand the economics. I have no problem with people trying to make money. But it's all about big data. It's about access. It's not like the revenue exists for one end, but the pay for order flow creates other avenues of revenue. It's big data. It's big data. That's what it provides. And I hated it when I was at Morgan Stanley. We would put a buy order or a sell order in, and all of a sudden the market would move before my order hit the floor because the black box would interfere with it. I don't like it. I don't like it from a trading standpoint. I think it's debatable on the liquidity side, because if these guys are front running the data, is that making liquidity better, or is that just shifting liquidity? Like, I mean, if they see selling coming, well, you know what? All the bids are going to disappear. Is that liquidity? No. Robinhood and Virtue need to widen out their models. They need to make themselves stronger financially instead of relying on this. I don't know why the SEC backed off of this. It doesn't make a lot of sense. It's not friendly to the retail investor. If Robinhood's in business or not in business doesn't make a difference to the retail investor, or Virtue for that matter. It's big data. It's all about the big brokers wanting this. They make money on it. They claim risk management. I bet you they probably said to the SEC it's a risk management thing. They can say lots of things. I don't agree with the SEC backing off on this. It's not retail friendly. It's institutional friendly. And while I am an institution and we don't trade, we don't use this sort of data for high frequency stuff. It's not all right. It's based for Citadel and those guys. I'm not a fan of it. I don't think it should have been approved, or it should have been approved with some sort of restrictions on the data. I mean, market makers didn't have access. All right, let me rephrase this. The guys on the floor of the NYSE did get phone calls ahead of placing trades, most likely. They had access to big data informally through phone calls when they were placing trades back in the day, and they'd get ahead of the trading. But they also had they manned a two-way market. This just doesn't, I don't understand why they backed off of this. I don't know if it was a trade with crypto, or there was some sort of trade. We'll do this if you guys back off on this. I don't know if the brokers agreed to give more access. It kind of bothers me. I mean, if Robinhood and Virtue want to be good businesses, diversify your revenue streams, get some better products, market to better people, get some high net worth clients to support the lower net worth. Don't rely on this. I don't know. That's my opinion.
Well, the SEC is going to come back. There will be some changes. We don't know to what degree. But this practice of payment for order flow, like in many countries around the world, is banned. So yeah, it is surprising that the US is going to stick with this. To what degree, we don't know yet.
But Gensler was all over him. Like, he was literally, this is a platform thing. Like, I'm standing up and I'm coming after Wall Street, and then he just backs down. Is it Gensler? He's at CFTC, whoever the SEC. I don't get it. It doesn't surprise me, though. This stuff's been going on forever. I mean, big data is big data. Everybody wants access to it. This is one way to get it. It doesn't help the small investor, and it really irritated me when I was trying to buy and sell. You don't see it in the futures world because you can't do a payment for order flow. I don't believe in the futures world, so we don't see it as much. But if I was trading stocks, nothing bothers me more than seeing the bid being there 1 minute and then the bid going away as soon as my order hits. It's like, that's not right. But anyhow.
All right, let's move on. It's light on names for earnings this week, but there's still some interesting names to look at. I always like digging in a little deeper. Cracker Barrel reports Tuesday pre-market. I've never been inside a Cracker Barrel, but I see them on highways all the time. So the pickup in traffic over the last 12 months, maybe we could see a little surprise here. But like all restaurants, there are also a lot of headwinds there. Inflation, price increases, tightening of purse strings with the customers. It all have a big impact here. Brendan, what are you thinking on Cracker Barrel?
So you and I haven't seen a Cracker Barrel because their clientele is 60 and higher. I didn't realize that. The over 65 crowd is a big deal for them. I didn't realize that until I was reading through the research report. They had a rough week, though. Darden missed, I believe, last week and then took a dive. It held like a rock, too. I was surprised it was holding in. But anyway, these restaurants are all dealing with the same pain. wage costs and commodity costs. There's commodity inflation is about 18% a year right now. Must be, I don't know what cheese being the cost, I guess. Cracker Barrel cheese, I suppose. Wage inflation is what it is. 8 to 10% is high. It's hard to operate in this environment. If your clientele is also on a fixed budget, I mean, over 65, you're going into retirement. So a majority of those going into retirement are living off of a stated wage that they built through a plan, or they're living through Social Security. So if the restaurant costs are all rising, it doesn't behoove you to go to a Cracker Barrel. It behooves you to go make it at home, or buy the stick of cheese and eat it at home. It's probably a lot cheaper that way. Their demand is waning in a bit. They've been raising prices, but I don't think we're in that. I think we're in that part of the market now where I don't think you can raise prices easily. I know a lot of people have been. I know General Mills is still getting away with it. Like, they had a blowout earnings report about a week and a half ago, I think it was, or was it last week? Not sure which. They're still passing through prices. Now, I don't know where they're doing it, because I was in the grocery store and prices aren't rising. I mean, prices for this stuff isn't rising. But going back to Cracker Barrel, can they pass through prices as easily? I don't think they can. I think that's going to hurt them. They cited catering as also a strength. Well, if the economy is weakening, is catering still going to be? I mean, there's the home catering. You create your own cheese plate. I honest to God, I've never thought about Cracker Barrel until the last 24 hours. So it's kind of fascinating as I'm saying this. I didn't even think of a cheese plate being a catering, but it is. I'm not optimistic on the report. Their clientele is not making a lot of money. Inflation's beating up everybody, especially those on a fixed income. I would be uncertain on the report going in. Like, their hit miss ratio is about 50%. So it's a flip of a coin, the last 8 reports. So there is a slight tilt on the revenue to beat. So there could be something on revenue, but costs and margins are probably going to hurt. And the stock's not trading well heading into the report.
Yeah, I'd agree with all those points. Moving on to Vail Resorts, and they report Wednesday after the bell. I'm more likely to be inside a Cracker Barrel than to be at a Vail Resort, because I'm not a skier. The company did announce a limit on ski lift tickets last month, which could lead to earlier commitment to buy ski passes. To me, that also sounds like the old ploy of buy now because these won't last. It can work. But Brendan, this one seems all about guidance and estimates for the winter. What do you think we can see from these numbers?
So this is their weakest time. This is their quietest period of the year where they lose the most money. They've been losing steadily less money at this time of year the last 2 years. So they've been steadily improving, but everybody has since 2020, right? I mean, we were all locked down. It couldn't get much worse. I'm wary on the skiing this winter in general, though, and we've had a drought all year. Rain has been at minimum around here in the east. If there's no rain and they got to make fake snow, it stinks. So it's not great. I'm not an avid skier. I know there's a lot more to skiing than just skiing. There's the experience of it all. But for me, who skis every once in a while, I'm there for skiing. And it's not, fake powder is just not worth it. Now, is a drought, so with that in mind, if the drought continues, is that going to raise their costs? Water costs in general, water's been an issue this year. If water starts to rise in price, then you add in wages, then you add in everything else that they have to deal with. Margins are going to shrink pretty good. I just don't think overcrowding is the issue. I think this is a smokescreen just to get more revenue in the short term, try to catch people in a skiing mood before the economy goes sour. In fact, I think it is exactly that. I think if the economy continues to weaken, might as well get the money from them now, because later they're not going to have the money to buy the ski tickets. Overseas, you see in France, they're raising lift ticket prices like crazy. I believe everybody's having the same drought issues. Can you continue? Again, is this an issue where you continue to raise prices, and will the consumer take it? Or will they say, screw it, I'm not interested in skiing on fake powder, and this is going to hurt everything they sell. So what's interesting about the company is they actually are growing year over year over year. They have a dividend of about 3.5%. The question is coverage in that. So I think the outlook is all important here. Early sales on their buy now. It's not pay later, but I want to say pay later, right? Buy now, pay later. But I would just say the outlook is key for them. I'd be so interested to see what they say about snow versus fake stuff. We're not there yet. We could be out of the drought in 3 months and this all changes, but it's a really big headwind. Water is a major issue, and droughts are major issues, and that could really impact their bottom line. I don't know if they'll talk about it yet because it's not an issue yet, quote unquote.
Okay, and then our Nike reports Thursday after the close. How much of an impact has China had on them? I presume that they will be talking positively of what the future holds as China reopens and their attempts to lift their economy. This could be a mixed news release, though, Brendan. As we've discussed earlier and in other shows, the market's focused on negative news right now. So we could see some positive and negative coming out of it. What do you think we could see from the earnings release?
So China, every Sunday, Monday, and today I put out the report a little late, but we do a chart view of the Asian markets, and the Hang Seng is so badly oversold and continues to cascade. That doesn't argue that China is bouncing by any stretch of the imagination, and it's been sinking. I remember we spoke about Nike back in March or April, and everybody was really down on them about China sales, and they came out and blew earnings away. That was the period where brand names did very well. Well, the stock's only been falling ever since. It's been cut in half in the past. It's been cut in half this year. Excuse me. Sorry. I got that cold going around. Everybody's got it. Excuse me. So why is the stock getting cut in half? Well, this argues that China's not getting better, but weakening further. That brand name bounce that they got is gone. I know that they're still a leader in the business. I mean, they have a great digital direct strategy. They get you the products quickly. So they figured out, all right, we're going to get you the shoes. So so that time frame where you can buy a shoe immediately and walk out of the store with, well, we're going to give you the shoes within 3 days or 5 days. So you don't have to get to the store. They've been still well ahead of everybody. But the chart, as you can see right there, is telling you that China's weakening. The U.S. is now weakening. It's kind of amazing to me. They're a powerhouse in the player. They're probably the best in brand, best player out there. But the chart is telling you a story that's not good. I think the market is expecting a miss based on this. It is a Dow it's a Dow member, I believe, right?
I believe so, yeah.
That's all factoring into this. I would just say that the weakness in the Hang Seng is ominous. That argues that China's getting weaker by the day, and the outlook for China will be weaker. And I'm guessing Nike will have to tell us that. And the U.S. is also having its own issues, as we've just said. It's hard to pass through prices. Inflation is still biting. I don't think it's going to be a great report. If they say anything positive, that could get the stock back above that break it down point. But I'm not too optimistic. I mean, a lot of these charts look really weak. I feel like too slighted to the bear side. But this chart looks terrible. And it's Nike. Like as you mentioned, Lulu's been navigating this quite well. Brand name powerhouse who's in China. And Nike is not. And they cater. Maybe Lulu's stealing their lunch too. It's tough to say. But anyway, they have to say something positive to turn the trend here. It is very oversold, but it's probably going lower. And the story in China is not great. I think people are underestimating how bad things are in China at the moment.
Yeah. Okay. And now Micron reports Thursday after the bell. There's a lot of negative talk going into these earnings. Wells Fargo wrote that the upcoming results appear very negative. But is the bad news priced in here? The share price has moved off its lows, so maybe there are too many fears out there on this one. What do you think of this one, Brennan?
So semis have been taking a hit. We've talked about NVIDIA and all of them. This stock probably is held in remarkably better, so to speak, but it's still been cut in a third. I mean, it's down to 65 to 50 in about 8 weeks. DRAM and NAND prices are the focus here. It's all about the outlook on those two. I remember Micron for years. Like we had a semi glut for years where you just had too many semiconductor companies, and that put downward pressure on NAND and DRAM prices. Honestly, I couldn't tell you what those prices look like right now, but everybody's a little worried about that sort of thing. Mobile phone and PC demand is also weighing down on Micron as well, which is also a headwind. That makes you wonder about Apple, if anything. If Apple goes, so goes the market. I don't know. Analysts are expecting a major drop in revenue. That's not a good thing. And a major shrink in margins, like 800 basis points. That's a substantial drop in margins. I think that's driven by the DRAM than NAND. The funny thing about all of this is, however, they have beaten 7 of the 8 reports. They keep beating on the revenue and earnings every time they report. They just keep taking it down in between. So at least they're consistent in that report. So if anything, if they were to miss, that's not necessarily expected, I think, by the market. I think the market's probably looking for support and a beat. But 49.50 is a big support. It loses that. It probably because an outlook on the outlook is not good. Semis are getting worse. It will be a key indicator for the sector going forward. Again, they'll look at Micron. They'll start selling everything else if it's bad. Maybe they buy up the sector on a good report. We'll see. Outlook and DRAM and NAND, though, is what analysts are particularly worried about. And again, that 800-point decline in margins, that's huge.
Yeah. Well, listen, everyone's super bearish right now. So
yeah, maybe it's just me. Maybe I'm too bearish. I don't know.
Listen, everyone we're speaking to is super bearish. And we've talked last week about the amount of put volume that's going on in the market as well. Like that is the general consensus out there. And usually I like to be like, all right, if everyone's saying that, let's go the other way.
Yeah.
But at the moment, I'm in the same boat. The market does not feel good at all.
Yeah, it's one of the charts was crude oil that we did this week, and crude oil has had the same setup as '08, and we've seen equity charts same as '08 in some cases, and there's just too much of that, which makes me wonder if this is not '08, because I don't think it is, but it's a lot of negative charts.
Yeah, it feels like one-ish to me. Tech bubble.
Yeah.
And the market's selling off like 1,000 paper cuts. But let's move on to like it, love it, leave it. This week's selection is some earnings and events that are happening this week. As we all know, this is what Brendan's got 30 seconds to give a quick summary of each one. So, Brendan, are you ready?
Let's roll.
All right, starting with CarMax, earnings on Thursday.
I'll leave it. Broke support through 81.50. Looks like it wants to extend lower.
Okay, Jefferies, they have earnings on Wednesday.
Leave it. There's something going on with the brewing bad with the banks. I don't know if Jefferies is a leading indicator of it, but the chart of the BKX is breaking lower, and Jeff broke hard to the downside this past week. Something's going on there.
And also reporting earnings on Wednesday is Thor Industries.
Leave it. Lost support at 75. Looks like it wants to get down to 65 next, give or take. That's not, great risk reward, I guess. It's right in the middle, but looks like it wants to go lower.
And one of our old favorites, Tesla. They have their AI day on Friday, and Twitter is set to depose Elon Musk as well this week.
This was a tough one. I could see both sides of this, but I'll go leave it. It reversed on 300. It's sitting right near support at 270, so the downside is sort of limited. It breaks through 270, it'll pick up steam. I hate to be bullish on Tesla ever, but right now I'd leave it.
Okay, Amazon is showcasing some new products this week, like their Echo products. What are you seeing there?
Ugly break this week through 120. I'm surprised by that, to be honest. I thought it would actually hold better on that breakout, but people have thrown it over the side. It looks like it's going lower.
Okay, and the last one we're looking at is Li Auto. They're launching their Li L8 smart SUV on Friday.
Amazingly, I don't remember this. I've never seen this company before. It's the first time I've ever charted it. I would say it broke. I would leave it. Broke support at 28, which is the 65 week, or 13 month. I think it's 65 week. The bounce this week, I think it might be sold. It's interesting. Is Li a Chinese company? I didn't even look that up. Yeah. So it's interesting that they're bouncing. I don't know. If a bigger theme here, if it starts to bounce, what's that say for China? After, I will say GM and Ford got absolutely destroyed last week. Autos in general are getting destroyed. Why is this one bouncing? That's my question, but I would leave it for now.
Okay. Well, that wraps it up for today's show. Brendan, thank you so much for your time as always, and good luck this week.
Short and sweet. Thank you. You too.
And for everyone else out there, good luck investing.